Why don't we get started with today's session? I'm Zach Caney from Lighter Capital. I'll be kind of hosting the panel and leading the slides here. And we're really fortunate today to have Brandon Bornanson and Danielle Deming, both C-level people and founders and from Seamless.AI. So maybe just right off the bat, Brandon and Danielle, if you guys want to give the audience a little color on Seamless.AI, what you guys are doing over there and what you're building, just for context.
Yeah, hey everyone, great to connect. We're thrilled to be with you this beautiful Thursday afternoon. Brandon Bornanson, CEO and founder of Seamless.AI. We are three-time entrepreneurs with a lot of success and even more failure along the journey. And we built a platform to empower the world to connect to opportunity and find emails and phone numbers for anyone in the world. So thank you so much for having us, and I'll let Danielle introduce herself.
Hey guys, Danielle Deming, Chief Operating Officer over at Seamless. Thrilled to be here with you guys today.
Awesome, thank you both. And then I'm from Lighter Capital. We also have John here, who's participating in the panel from Lighter Capital, one of the directors on our sales team. So John, you want to give a little background and color on Lighter Capital for the audience?
Yeah, sorry, I just cut out a little bit. So I'm John with Lighter Capital, work on the relationship origination side. So work with companies like Seamless throughout the country, and then also work on some of our international expansion efforts as we're looking to expand to Canada as well as Australia. And Lighter Capital is a venture debt lending firm that works primarily with B2B SaaS companies, some equity sponsored, but mostly kind of non-equity sponsored. To date, we've provided over 200 million to nearly 400 companies throughout the country.
Thanks, John. And just a little housekeeping to begin. We'll be recording the session and sending out a link to the recording as a follow-up for all the people that have RSVP'd and joined today. And separately, as you can see in the chat, we do have a Q&A feature here with Zoom. So please, anywhere along the way, pop in your questions. And for the topics today, we're obviously through the comments and introduction now. But anywhere in the 12 metrics that we'll be going over, please posit your questions and we can address those as they come in. And then anything remaining, we'll have some time at the end to do a little bit of audience Q&A. So thanks for joining, everybody. Really excited to get started here. All right, so now, as you can see, we have the 12 metrics we want to talk about today, and we've kind of bucketed them into 4 categories, each with 3 of those metrics. So maybe right off the bat, let's start talking about revenue resilience. And again, the context being here now in 2020, why are these metrics important? Do they, and how do they impact, and how do we want to think about their impact on profitability, especially for tech companies, early stage startup companies, et cetera. So maybe right off the bat here, let's talk about revenue mix and thinking about recurring versus reoccurring, any kind of residual or one-time revenue. I don't know, Brandon or Danielle or John, do you guys have any initial thoughts around how companies should be thinking about revenue mix?
Yeah, well, I know people like John and Zach love to see monthly recurring revenue, right? So at first, when you're launching, you're going to kind of try to sell anything to anyone that you can, whatever product mix, whether it's month to month or annual. But to create a predictable, scalable, and repeatable revenue engine and platform that truly changes the world, you need to have recurring customers. You need to have recurring payments. It's the only way to forecast. It's the only way to figure out the demand of talent that you can bring on given future revenue that you know that you can bring in no matter what. So our passion, our purpose is on acquiring lifetime long customers, and that's where that LTV comes into play. And all the bankers, anyone from investors to venture capitalists to venture debt partners like Lighter Capital, they're going to want to see an extensive amount of MRR and ARR on the books. So, but that's not how you start, right? When Seamless started, we did month to month. When Salesforce started, you did month to month. And then, you get product market fit, you get a bunch of customers, and then you move to more, hey, okay, we're going to go to annual contracts. Hey, we're going to go to multi-year contracts. Hey, we're going to move up market, you name it. So my recommendation would be step 1, sell someone something. Step 2, try to get an annual commit, monthly, quarterly, annual payments. And then step 3, drive up the price, drive up the length of the contract.
Yeah, thanks, Brandon. Let me comment on it briefly too. So obviously we have a preference for recurring revenue models. We will look at companies that have monthly, biannual, annual, and multi-year contracts too. So we'll actually look at all of those. Are fine with that, but we do prefer companies that are primarily B2B SaaS and mostly recurring revenue.
Apologies
Zach,
there. I was
there you
muted.
go.
Just piggybacking, Brandon, off your comments, then, obviously you want to build up that nice, sticky, recurring revenue stream as you go. And there's a lot of ways to do that. But once you attain that, kind of, what are you doing to monitor, how that's going on an ongoing basis? Or is there kind of an ideal proportion of what, like if you have initial onboarding services you charge for, and then there's a subscription, or is there like an ideal balance that you think, or going full recurring, just flat subscription is the dream, or what do you think?
Yeah, so to monitor the KPIs, that's like the hardest thing for a founder and entrepreneurial team to do when you're wearing 19 different hats, right? Because for all the founders here, you may be a CEO, CTO, COO, CIO, all the above, chief security officer, you name it. So then having to create custom, 19 different custom dashboards, P&L balance sheets is exhausting. The tricky part is you need to know your P&L, your balance sheet, your cash flow, your MRR, your ARR, your forecast, your churn, your LTV, you name it. So I recommend the first thing you invest in is a KPI dashboard that connects to your payment gateway. So the thing that changed my life, and I wish I knew about it, I operated for about a year without this, but I came across a company called, I'm going to give you a few different platforms for KPI management. Bear Metrics. So this is the one that I use. I love it. The dashboard and KPIs are beautiful. You're going to be able to tie it to any payment gateway like Stripe or ChargeBee or Visa, whatever you use. And then you've got platforms like Profitwell, ChartMogul, First Officer, SaaS Optics, MRR.io, and then you've also got Stripe Analytics and Dunning, which I believe is included, but it's not as visual. So these platforms will allow you to track everything that any investor would care about and that you should care about operating your business. Annual recurring revenue, what's your ARR today, this second? MRR, what's your monthly recurring revenue right now, today, this second? What's your LTV, lifetime value? What is the cost to acquire customer? What is the average revenue per user? What's the MRR growth rate? What is the revenue churn, user churn, net revenue churn? What are your number of active customers, new customers? What's your quick ratio? Quick ratio means how many new customers are you bringing in versus how many are losing. And these platforms will help you automate all the reporting. So you just log in. And like for me, I have 7 monitors in my office, and one of the 7, it just has Bear Metrics live 24/7, and it just auto refreshes, I think, every 30 seconds. That's how important I know these metrics are for managing, maintaining, and just having a direct dialogue with your business KPIs every single day.
Yeah, and let me actually just piggyback on that. When we were looking at Seamless.AI and looking to put together a term sheet, these are all metrics that we're looking at and thinking about that Brandon and Daniel were able to produce really easily. So definitely really helpful if you're looking at any sort of lending options or venture capital. These are all metrics that any sort of investor want to understand.
Yeah, and a couple quick questions from the audience. We'll have a recording of this. So if you want to go back and review the KPI dashboards that Brandon had mentioned, you can just skip to it in the recording as a follow-up for everybody here today. And then I guess one tangential question in the chat that's related is, if you're more of a services model, like an engineering firm, should you be trying to get to some kind of recurring revenue stream, or how much you think about that? Maybe like via retainer. I don't know if anybody in the panel has thoughts around, making a services business more of a recurring revenue business.
I can comment on briefly because we'll occasionally fund services businesses if it is kind of contracted or reoccurring. So if you can get sort of multi-year service agreements, those are companies that we'll look at. So you have 3-year agreements, high gross margin, that sort of thing. We'll definitely take a look. So we've funded, for example, managed services companies.
Thanks, John. Appreciate that. And now, so these companies.
And to tie into that, so like real quick, so services-based businesses get a 1 to 3x multiple. SaaS or recurring-based businesses get a 10x multiple. So like, as founders, Danielle and I are just transparent. So like we sold for IBM and Google. We noticed that like IBM would get a 3x multiple when they were fundraising, for different business units because they were a services-based business. And then all the software business units that they had, they got massive multiples because it was all recurring. So services-based businesses can go from project fee to a recurring, hey, instead of charging $25,000 for a one-time project, do $5,000 a month. So then you take the $25,000 project fee and you just turn it into a $60,000 recurring revenue deal. And then you could try to turn that into a multi-year deal. So I highly recommend like whatever products and services you sell and offer. One, as a services-based business, you're probably charging too low. So I recommend double the price by turning it into a monthly subscription fee with an annual commit. It's the best way to just get away from the peaks and valleys of customer acquisition and customer management.
That's excellent. Thanks, Brandon. So yeah, let's touch a little bit on revenue stickiness, thinking about churn, repeatability, logo churn versus revenue churn. Why is that important? I mean, obviously these founders have worked really hard to build a revenue stream. Where does the stickiness come into play?
Yeah, I can touch on that real quick. So, ideally each industry, each company is going to have different benchmarks for revenue churn, net revenue churn, user churn. And I think your goal is to identify what is the industry benchmark. For example, Seamless is a freemium software. Our industry revenue churn for freemium software with the ARPU, average revenue per user of $100 a month, is typically 7.6%. So now I know like what the average is, and my goal is to be the top 1% of the pool. So then it's like, okay, if they're doing 7.6%, I want to have 0.5% revenue churn. And then the dreamland is net revenue churn. So if I've got 0.5% revenue churn month over month, that's roughly 6% a year. And then the goal is to have your customers buying more products and services and also referring new customers. So that's when you get into negative net revenue churn. So you see why companies like Slack, they skyrocketed, was because they had very low churn and the customers that they acquired added so many licenses and grew across so many business units that I don't remember the exact number, but it was in the negative 100s of percents. And that's why they did so well on the public markets. That's why Zoom Video is another one. All these companies that get into a customer and then scale it to multiple either products or just users have massive net revenue churn in the negatives. And that's really the ideal state. And that just goes to show you that people love your product, and they're not going to leave in a month, 6 months, 9 months down the road, you name it. So I would find the industry average, and your goal should be to perform in the top 1% and just know it's slow and steady wins the race.
That's excellent.
Yeah. And on that point too, I think it also depends on the segment, right? So SMB, obviously you're going to have a higher churn rate naturally, but if you're selling into enterprise, right, you better have, an annualized churn rate higher probably than, no higher than 10, 20%. So it really depends on the segment as well as the industry.
And sorry, skip the slide here. Let me go back. There we go. Apologies, everybody. So let's talk about real quickly before we move to the next set, contract duration then. Is it important to get those multi-year contracts for every type of business, or does it depend on your audience, or how should entrepreneurs be thinking about that?
Yeah, I think you should, multi-year is great, and you should definitely create a 1, 2, 3 year model. I believe for our 2-year model, you get an additional 10 or 15% off, and then a 3-year contract, you get like 20 or 30% off. It's like, I think 10, 10, and 10 or something like that. Luckily our sales team has grown really fast. So I'm not in the day-to-day anymore, but I definitely recommend have a 1, 2, and 3, but the bigger focus everyone needs to understand, like all these companies, they either survive and thrive because of sales. So instead of worrying and losing sleep all night and day about, do I make this a 1, 2, 3-year contract? Your goal should be, how do I acquire 10 more customers versus everyone coming in? And if you continuously prospect and fill the top of the funnel, and you're constantly just packed in back-to-back demos and appointments and driving sales, the 1, 2s, and 3s will flood in. I think it's less of an importance and more an importance of the number of opportunities getting into the funnel.
Awesome. Thank you.
Yeah. And as a lender, we love multi-year contracts too. So we'll look at, monthly, biannual, annual, but multi-year are great as far as how we think about structuring deal. It does present a little bit of kind of a cash management issue for a company getting those upfront payments, but definitely a great structure for us to look at as we're thinking about venture lending options for a company.
The other thing I'll say too is, depending on where your price point is at, when you're getting into multi-level contracts, there can be a lot of redlining and legal. And when you are a startup, sometimes getting those kind of enterprise 2, 3-year deals can be so costly to you. So I think just like creating your client base and just getting people in the door and working on your sales at first is most important. And then as your business grows, you'll be able to be in a better position to go up market and enter into those multi-year contracts.
Thanks, Danielle. I think that's a good segue. Let's get into our next set of KPIs here. So let's talk, this bucket's more about industry and segment. So let's talk about how a company might want to think about expansion or how they're attacking the market and growing either horizontally or vertically, and kind of if they want to be very segment focused or really broad, a generalist in terms of how they're approaching their customer base. Anyone in the panel want to jump in with thoughts around that?
John, I don't want to hog the mic. I'm trying to be respectful.
All you, go for it.
So here's the deal. I recommend you pick a niche to get rich. 0 to 1 million, you need to pick a niche to get rich. And like the fastest way to scale to 0 to 1, 7 figures, we've got an award for it here. We call it the 7-figure award. When anyone generates over 7 figures in sales using Seamless, we ship them this award. So getting you to the 7-figure club is really important to us as fast as possible. And the only way to do that is by going vertically. And what they mean by, do you go vertically, horizontally, pick a segment or industry? It means pick one industry, one persona that you can help, one employee size, and then write all of your messaging and build all of your lists to sell to those customer personas. So for example, when Seamless launched, we were like, okay, we help, what's our industry? SaaS companies, okay? Who's our persona? We help VPs of sales at SaaS companies. And then what's our ideal employee size? 50 to 500. So we help we help VPs of sales at SaaS companies who are growing from 50 employees to 500, employees, flood the calendar, generate millions in sales, and then you could use like these different value propositions. So that way, when you're building your list is like a sniper rifle prospecting acquisition machine, right? It's very focused, only VPs of sales at these types of companies. And then your messaging, your cold call scripts, your email scripts, your voicemail scripts, your social scripts, your pitch deck, right, is so laser focused on that one industry, that one persona with that one type of pain point, KPIs, responsibilities, that when they get your email or your call or your pitch, it lights them up like a Christmas tree or whatever you celebrate. And then they book the appointment and they buy your products and services. So I highly recommend 0 to 1, stay laser focused on one segment. And then from 1 to 100, you could start diversifying at scale. And the larger you go, like every million or every few million, I think you could add on another segment. And that's at least what we've done, to go from 0 to 8 figures very fast. And as we look to go from 8 figures to 9 figures, then you're going really wide. So first we went deep and now we're going super wide.
Yeah. And I know Brandon knows more your world, but Kind of curious too, as you're thinking about kind of horizontal versus kind of a vertical strategy and what that's looked like, how that comes up in conversations when you've talked to VCs, or as you're thinking about equity financing. Obviously, a VC wants to see a more kind of broad horizontal offering. So I'm kind of curious what sort of feedback you've gotten as a company as you've talked to investors.
Yeah, when we pitched investors, you show the massive TAM, right? Of like, here's the broad, massive market, and here's our SAM and TAM, and what we're gonna acquire over the lifetime of the company. And we show here are all the industries, the ideal customers, personas. So when you're pitching investors, you definitely want to showcase like the broad market opportunity. We call this total addressable market. And you want to present the plan to VCs, how you're going to acquire the total addressable market. But then you want to be methodical and strategic. If you go to VCs like John and Zach, who are leaders in the game, and you're like, hey, we have no competition, and everyone's going to want to buy our services, and anyone can use it, they're going to think that you don't know what you're doing. If you're like, hey, here are the 10 industries that would value our product the most. Here are the locations. Here are the titles. Here are their budgets. Oh, and by the way, here's our plan. We're going to start with this industry first, with our idea. So here's our prototype. We're going to sell the idea to this one industry to go from 0 to 1. And then from 1 to 5, we're going to sell to these 5 industries. And then from 5 to 50, we're going to sell to these 10 industries. That just presents a very methodical growth approach where any investor would be like, okay, that makes sense. Because investors know all these companies, you start very niche and then you scale. Like PayPal, look at PayPal. They started as an eBay payment solution. Like, okay, well now they're the global leader in commerce banking, right? But they started as a PayPal payment provider. An eBay payment provider. So all the investors, they know you start as a niche and then you grow.
And operationally, maybe Daniel, you want to give us a little color when you're attacking one of these niches. How do you want to build your sales team? What kind of structure or what's, how do you think about headcount or any of those kinds of things as these companies are trying to scale?
So I think that looking at headcount, it's a lot. It's really a group focus. It's not just me. Brandon and I, we meet with our CFO and we look at what our revenue is. And then once you figure out like the metrics on how many demos you need, how many demos you can book a day, how many of those are going to turn into actual deals, then you can start actually creating that funnel of when you need to start adding headcount to your team. For Seamless, our largest body of employees is our sales team, and we have it broken up into both an outside sales team and an inside sales team. So we've got our SDRs who are booking appointments, and then our account executives who are in 4 to 7 demos every single day of the week.
That's awesome. That's really actionable. Thanks, Danielle. And now as we're thinking, and we've touched on this a little bit, about customer concentration, which is the flip side of, thinking about churn. For a new company going to market, what do they want to be aware of in terms of how they're attacking a different type of customer base, whether that be enterprise and the associated longer sales cycle, or SMBs and the associated higher churn, or, is there a right answer, or, niche to get rich, Brandon? I like that. How do you really like hone in on who you should go after?
Yeah, I can comment on this briefly.
Ahead,
Okay, thanks. Obviously it depends on the industry and the segment a little bit. Some areas are more concentrated, right? So we'll see companies that are selling into, it's like a biotech, like SaaS solution, right? And they're selling to pharma, right? That industry is really concentrated. So you're just naturally going to have a lot of concentration there. But, if it's like a company or solution for SaaS companies, that's a little more segmented. So it's not going to be as concentrated. When we look at companies, ideally we don't like to see any one customer account for more than, call it a third of revenue. So we are pretty sensitive to concentration. So definitely prefer companies that are a little more segmented. And the concern with that is just if you lose a major customer and what that means for the revenue loss.
Thanks, John. And I guess that kind of leads into the last bullet here, the last KPI or thing to be thinking about. Obviously we're here in 2020. There's a lot of pandemic and potentially recessionary impacts to industries, customer bases, et cetera. Are there certain industry segments that we think would be more impacted, or something to be cognizant of as you're thinking about, here, now, and today, like who you're going after? where are you worried about, hitting a customer segment where they don't have the budget to really buy your offering, or how should entrepreneurs be thinking about that?
Yeah, to piggyback on what John said, I think it's all a focus on sales velocity. So right now during the pandemic, you really want to be targeting the industries that have a high sales velocity. And what that means is you can prospect and close new business very fast, because let's just say the economy is in a downturn and you need to provide for your family, your employees, your company, your investors, you name it. So what I would do is I wouldn't invest all my eggs into moonshot enterprise deals. I would work on these deals that have a high propensity to close fast. And that's what we call sales velocity. So you want to have a good mix of like high sales velocity deals and then longer moonshot, bigger enterprise deals that may be slower to close. So that way you could bring cash flow in immediately while also building a big pipeline of long-term revenue. And yeah, when it comes to the industries, I invested in a lot of the industries that got hit pretty hard, because I just see it as a big market opportunity. You've got travel, you've got hospitality, you've got bank, you've got retail, you've got tourism, you've got oil and gas. All of these industries that have been, you got staffing and recruiting. So all of these industries just realize, I would probably go after the industries that didn't get hit. Like when you're looking at lead scoring, you have to lead score all the deals and you have to lead score all the prospects that you're going to go after. I would prioritize the leads that were hit the least. Go after them first, because that's going to have a faster sales velocity, and then go after the ones that were hit second. Now, if you sell delivery services to restaurants, well, now's the perfect time. All they're doing is delivery. Then you want to go all in. So it obviously depends on if you sell N95 masks. So it depends on the product and the services, but always try to prioritize your leads based on the market opportunity and sales velocity.
And then I'll just piggyback off that just briefly. I think the other part is just being more creative now more than ever. As an entrepreneur, all of us learn at a very young age that you have to be super highly adaptable to anything that's going on. And whether it's COVID-19 or the next thing, there's always going to be something that's impacting your business in some way. So it's also just like thinking creatively, thinking about a new way to reach your customers, to give back to your customers, and to meet them where they're at.
That's awesome. Thanks, Danielle. And appreciate the context, Brandon. So just to keep things moving along, let's look at our third bucket here. Now we're going to talk about go-to-market and specifically these metrics underlying that. So let's talk about unit economics, first. Customer acquisition cost, lifetime value. We talked about KPIs at the very beginning of this, but specifically these measurable quantitative KPIs. Why are they important? How should entrepreneurs be thinking about them? And I'll leave that to the panel.
John, if you're back in, I know you.
Sorry, kind of cut out. And let me go back actually to the COVID-19 industry question, because I actually did want to comment on that just because we see so much of that. So the industries where we've seen the most adverse impact have been, anything kind of travel, hospitality, entertainment, events, anything kind of bookings oriented, right? Kind of movement of people. I think I have a friend that's an equity research analyst and he calls it the BEACH acronym. So bookings, entertainment, airlines, cruises, hospitality. So those are the industries where we've been avoiding and seeing the most impact in our portfolio. These companies have all had significant fall in revenue. They've been forced to make corresponding expense reductions. On the contrary, though, we are seeing a lot of companies that are benefiting. Anything ed tech, enabling online distance learning, delivery services, streaming content, and kind of broad healthcare IT. So those are areas that are actually benefiting from the current trends.
That's great. Thanks, John. And then, just circling back to the first item here, how should entrepreneurs be thinking about customer acquisition costs, lifetime value, and how they're measuring them or looking at them? And again, Brandon, you already touched on this a bit in the beginning, but any other thoughts here about specific metrics that you really want to keep an eye on?
Yeah, I would try to make sure you've got at least a I always love to see a 10x LTV to CAC ratio. And what that means is the cost to acquire customer, the lifetime value is worth 10x minimum the cost. So if it costs me $100 to acquire a customer, I want to make sure that lifetime value is at least, $1,000 minimum. Now, if you're in high growth mode, there were times where, even now with how fast we're growing at Seamless, we're just looking to break even or make money on the customers that we acquire. Now, luckily for us, our first year contract value, we acquire customers far less than our first year contract value. So it's about 20% of the first year contract value it costs us to acquire a customer. And then our LTV, we get a 12 to 14x LTV. But, I always like to just make sure you understand from Google, Facebook, LinkedIn, social media, outbound sales, inbound sales, what is the CAC per channel? And this is stuff, guys, we've been running this company for a few years now. Year one, we didn't know these numbers. Like, you don't even know if your product, anyone's going to buy it, right? In the first 3 to 6 to 12 months. So we may sound advanced, but we've been in your shoes. And it took us years to get the data and to get the tracking and the reporting and the people to figure out the CAC. But what I can say is the sooner you can master your numbers, the sooner you're going to be more prepared to be able to grow your business, manage your business, make strategic business decisions to capitally efficiently scale it to maximize value to your users, your customers, your investors, and you're going to be the most attractive to people like John, Zach, venture debt, venture capitalists, PE firms, you name it, because when they ask you, what's your CAC in Facebook? What's your CAC in inbound SDRs? What's your CAC in LinkedIn? What's your CAC in Google ad spend? What is the average time it takes to acquire a customer? What is your LTV? What is your quick ratio? When you can boom, 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 and you can name off all the statistical data points, they just know they're investing in a business operator that knows their business inside and out, and it creates a confidence level that if they know their business metrics right off the rip, they're probably making smart business decisions to continue scaling it. Now, you also need the execution to match. You can know all of these numbers, but then if your business is going like this and tanking, then it doesn't matter. So you need both. You need to know the business metrics, and then you need to be growing the business effectively and efficiently.
Hey, Brandon, would you mind, because I was always really impressed about how you thought about these metrics and making investments in the business, or Danielle, would you mind commenting about how you think about kind of CAC and LTV when thinking about your marketing and sales strategy and making investments in marketing and sales, whether that's, all the LinkedIn ads you guys do or adding another SDR to the team?
Oh, yep, I'm on mute. There we go. So lifetime value is how much you can expect to make from the average customer before they churn. So knowing your LTV will help you decide how much you can spend to acquire and support each new customer. The best way to calculate this is average monthly recurring revenue per customer divided by the churn rate. So you take the average MRR, you divide the average user churn rate, and that will equal your LTV. So for us, to acquire a few customers, it costs a few $100s per customer, and our LTV is almost, minimum of 10 grand. So we know our LTV to CAC ratio is massive in the double digits, right? So you really want to understand average MRR divided by user churn rate, that equals your lifetime value.
And the next item here is sales cycle. And again, this is under the context of go-to-market, especially now. What are some things that founders, entrepreneurs should be wary of as they're thinking about a short sales cycle versus a long one, as maybe they've got MVP and they're trying to launch here in 2020? What are the big kind of ideas that they should be cognizant of?
I would sell as fast as possible. But It was so funny because we got coached from some of the smartest people that built Google search, AOL search, you name it, when we were building Seamless.AI, the world's best sales leads. And luckily we've got amazing backers like Lighter Capital, like NVP, Jumpstart Angels, all of these amazing investors. And a lot of them coached us, build the prototype, design the prototype a million times over before you spend one dime on development. Before you go hire 5 to 10 developers, design the platform and the prototype to be perfect and get it in front of as many users as humanly possible to get feedback and then iterate on the design and go sell the prototype. So my first 50 to 100 deals of Seamless was a clickable image using Photoshop prototype. We didn't even use Photoshop because we weren't smart enough. We used Snagit. So we literally bought a $40 license of Snagit and we're designing the prototype of Seamless in Snagit. We had like a 190 different images where we would copy and paste them into Google Slides. And then when you click a button, it would go to the next slide. So it looked like it was animated. So you can literally take a prototype and go sell it. And then the way that you sell that is you say, hey, look, we built this amazing product. We'd love to earn your business as a beta customer. For being a beta customer, I'm going to give you 80% off, 50% off, 20% off, you name it. I'm going to have you sign the contract. We're not going to bill you until it's live. And that way you could sign a bunch of customers and then show someone like John and Zach, hey, John and Zach, we're not even in market yet. We've got a beta product that's got $100,000 in ARR ready to go, and 8,000 in MRR, 100,000 in ARR. And they're going to want to invest. They're like, these guys didn't even go to market and they've got all this money coming in with signed contracts. So I recommend like whatever you can do to get fast sales velocity, get money coming in. Even if your deal is high ticket deals, just try to figure out how you could architect it to keep shortening the sales cycle. And every month, if it's 100 days, the next day, how do I get it to 99? How do I get to 98? How do I get to 80? How do I get to 50? How do I get to 15? And just be obsessed with improvement. Like I believe happiness is a state that just doesn't exist, but I believe improvement is like the lifetime be-all like state of mental and physical and emotional happiness. If you're always improving and you're always hungry to improve, you're going to win big. So do that with your sales velocity and your sales results.
Brandon and Daniel, I'm kind of curious. So one of the things we're seeing as we look at different companies right now in the past couple months is with COVID-19, obviously a lot of executives are putting off making decisions about purchasing products and solutions. And people are telling me that their sales cycle is increasing. Have you guys seen that on your end? When you're talking to your customers, does it look like the sales cycle is increasing just based on the pipeline data?
So luckily for us, we've got emails and cell phones for every professional in the world. So, I would say it's like N95 masks, Zoom video, and then Seamless to be able to sell to anyone. So for us, it's hard to say, like, we're just lucky in the right time, right place where everyone's going remote. You can't use old, outdated, databases. So you have to use a platform like Seamless to connect with them and connect opportunities. So luckily for us, our growth rate has increased and sales cycles have gone faster. That being said, we had a massive Berkshire Hathaway client that went out of business. They're just gone. And you're just like, what do you mean the company doesn't exist anymore? What do you mean it went out of business? So you've got all of these things that are happening where decision makers, their budgets are destroyed. Divisions are getting laid off. And my recommendation to combat this, the number one recommendation, like, you just have to realize you're one list away from the life you want, the sales you want, the customers you want, the investors you want. Everything you want in this life is just one list away, and you have to go find that list, build the list, and sell to it day in and day out. The way to fight long sales cycles is to have 1 million deals. And if you have 1 million deals in the pipeline that you're finding, pitching, closing, and acquiring, you don't even have time to think about the sales cycle and how long or short it is because you've got such a big pipeline. So to combat an economic collapse, to combat the downturn, upturn, whatever it may be, it's all about increase your sales activity by 3, 5, 10x, flood the funnel, flood the customer acquisition gate, and that sales cures all. Sales cures all.
Lighter Capital is also a Seamless.AI user too, so I can also endorse the solution. So.
Thanks all. And now just last metric here, the 9th one of the 12 that we're covering today, implementation, especially for software offerings that have some sort of implementation and aren't necessarily purely cloud-based standalone. What are some things to be wary of as entrepreneurs, are looking at how to sell their offering that requires some implementation or setup?
Yeah, I think you should definitely charge for setup. You should definitely charge for implementation. This takes a lot of time and effort from so many people and so many resources that it's a great opportunity to get 10, 20% of the contract value up front and put it into the contract. Hey, if you're going to buy our services, you're going to buy our software, here's the $100,000 deal, and we've got a setup fee of $5,000, $10,000, whatever it may be. And that just creates a lot of additional cash flow revenue for the organization, and also covers the cost that your CS team is going to invest, your engineering team is going to invest, your post-sales support team is going to invest. So I highly, highly recommend, investing in all of your contracts, getting setup fees integrated into all of them, because there's just so much effort that goes from acquisition to lifetime customer that you have to be prepared for.
Brennan, on that point, since you brought it up too, or Danielle, you mind kind of talking a little bit more about customer success and how y'all think about that and how that's really important for renewal rates?
Yeah, and just before that, the one thing I was going to piggyback off of what Brandon was saying, I think it's really, really important when you're working with your customers on the implementation part that you really understand your customer base, because when someone is paying an implementation fee, they want to ensure that your product or service is definitely going to work for them. So just be really considerate of that when you are including an implementation fee. As far as customer success, we have both a support side and then also an enterprise customer success side, which is something that's newer for our company. When we first started out, we weren't focused on the long cycle enterprise clients. And so for us, that's like a newer team that we've added to Seamless.
That's really helpful. And then just one comment that I had a thought around is, if you're looking at giving free implementation to help close a deal, just be very cognizant of what it's going to cost you and ensure that you're getting a long enough, sticky enough contract that you're not going to try to finish an implementation, have them cancel, and then you've wasted time and money and not received any kind of benefit if you have, easy outs in your contract or they're very short. All right. And now, before we get to the final Q&A, where we'll try to get to a lot of these questions in the chat, let's go through these last 3 financial metrics in this last bucket. So, obviously everybody's dealing with the larger, broader economic impact of the world today. How should entrepreneurs be thinking about revenue growth now versus what it may be Q4 going into next year? If they are having a tailwind because their offering helps remote and socially distanced, kind of workflows, or how should they be thinking about trying to set themselves up from low growth to high growth later as hopefully the world normalizes?
Yeah, let me touch on this kind of more in the metrics we're looking at on a daily basis when we're evaluating companies. So on the revenue growth side, so since Lighter Capital is a lender, not a VC, right? We don't require equity sponsorship. We don't have warrants. We actually don't need to see the sort of high growth metrics that your typical VC is looking for. So usually VCs are going to look for a company, depending on the industry, on 100% plus year over year. We're actually, as a lender, we're more comfortable with lower growth rates. So we have a preference for companies that are more capital efficient, and these companies can be growing 10, 20% year over year. So we're, first off, I would say I'm kind of more comfortable with lower growth companies. The other piece to add to that is, right now it's hard to grow quickly. It's hard to get to the growth rates that a VC wants to see. And I think in some ways right now more so than ever, where terms and valuation multiples are not as favorable for an entrepreneur, there's actually a stronger use case to look at debt-based financing solutions, like a venture debt, venture lending structure that Lighter Capital offers. On profitability, I would say we definitely have a preference for capital efficient companies. It's not your stereotypical kind of hyper high burn Silicon Valley company. Think about it from a net profit margin perspective. Typically, we're looking for net profit margins kind of no worse than -50, -60%. And all of this will tie into runway too, right? So obviously, if you're not growing as quick, we're going to want to see a longer runway sort of thing, right? Right now, we are wanting to see longer runways than say 4 or 5 months ago, given kind of what's going on in the world and how unfortunately sustained this crisis looks. So right now, we're actually, we want companies to have, call it kind of a 6 to 12 month runway, just given what's going on. So, if you can shore up the balance sheet, kind of ride out the current crisis, definitely great. Obviously, there's been a lot of amazing programs like the Paycheck Protection Program that entrepreneurs can take advantage of. And I know that Seamless has, and maybe they can comment on that. But those programs are certainly helping companies.
Yeah, maybe that's a good segue. Just broadly speaking, how should entrepreneurs, to either Daniel or Brandon, be thinking about, we may have another wave of PPP coming up or other kinds of business support loans and things from the government. How should entrepreneurs be thinking about trying to go after those and versus how they spend their time otherwise in terms of keeping the business going and growing, hopefully?
Yeah, I think if you have someone on your team, so for Brandon and I, it was really great. He was all in on growing the business and growing the product. I was able to spend my time as chief operations officer looking into all of those programs, and you need to take advantage of all of them. It's almost irresponsible to your business not to. It could end up being free money, especially for the payment protection program as you're growing your company. I will say that you need to be extremely diligent. You need to document everything. And as soon as you get that money, set up a separate bank account, keep it in a separate bank account, have the exact date that money went in, the exact total. And then I have it down to the penny, how every single cent was spent. And then also the backing corresponding documents to go along with it. And then my intention is when banks are able to start processing what the forgiveness piece will look like, you don't need to be number one in line, but you don't need to be last in line. So I think just being really considerate on your timing. I think whenever you're first and it's a new program, the banks and the government need time to kind of work out some kinks. So you want to be a little bit patient, but not so patient that you sit back and you miss on it. And I think the other thing is that I know some businesses applied and didn't get through the first time. So that just means apply again, apply for the next tranche and the next tranche. We also looked into the economic injury loan. And again, work with your CFO, but for us, these loans made sense. Understanding our business and our numbers the way that we do, taking on a loan at such a low interest rate was really a no-brainer for us. And it made perfect sense. And that can really help businesses kind of get over this hump, especially right now, where you may not have the financials that look attractive enough to a venture debt firm or to a VC right now. The government's not looking at those metrics. So take advantage of it so that you can get funding in the door right away.
And this is why it's also really great comments, Danielle. And she was amazing. Like, you need to find a partner in your business who can come in and just make it happen operationally. And Danielle is our rock and our foundation to do that. And she did an amazing job with the CFO and Lighter Capital. So this is why you need to find an incredible financial partner. We were looking to raise a big Series B round. And when we were evaluating the market, it's like, okay, we could give up a bunch of equity and, give up a board seat and all these things, or we could partner with this amazing, incredible financial partner that has backed some of the fastest growing companies in the world, like Lighter Capital. And we eventually decided to partner with Lighter Capital because not only did they provide amazing capital opportunity, but in terms, but also right when the economy was going through the tumultuous time and the recession, and then the government came out with the PPE loan, we reached out to John and Zach and the team, and we're like, hey, we've got this amazing opportunity to take this amount of money, and they're like, fully support it. How can we help you? Like, this is why it's so critical to build in your startup the right people at the table. As we build Seamless to positively impact 1 billion people, I got to find people like Danielle who can run the financial and the operation. I got to find investors and backers like John and Zach who not only can help lend us the capital we need to grow, but also support us finding other options too that are available that may be, very cost effective. And we implore every entrepreneur to go after all options. And in the press, they all say, oh, this company raised 100 million here, 5 million here, 2 million here, and they make it like celebrated that you just sold a big piece of your company to someone for a bunch of money. And they should be celebrating the exact opposite. Hey, this entrepreneur bootstrapped and did all of this with all their own money, and they found product market fit, and then they partnered with a company like Lighter Capital, and they're acquiring customers very profitably. Like, the problem is that it's not cool to the news and the press to feature that stuff. So, just make sure you surround yourself with the right people, the right partners. I'm grateful that during tough times, good and bad, I can lean on people like John and Danielle and Zach and different teams to help fight through those situations.
Yeah, I appreciate that, Brandon. And as a follow-up item, I would say, just like the Paycheck Protection Program provides optionality, that's what we're seeking to do with our funding model. So, maybe it's not the right time to raise an equity round right now, or maybe what's going on in the world, you want to wait 6-12 months until the market normalizes a little bit more. And that's really what we seek to do, is we seek to help companies that want to retain that early equity. Maybe they want to push that equity financing downward by 12, 18 months to the point where.
That's awesome. Thanks, everybody. And just as we think about kind of making sure we allocate some time for the broader Q&A, profitability, liquidity, when to drive to profit. If you're bootstrapped, maybe you have to from day one. And then if you are burning, how you manage that liquidity. Obviously PPP, IDL, these are some options. Finding companies like Ladder that can support you, or VCs or angels if that's an option. But I guess big picture here right now, today in 2020, what should entrepreneurs be thinking about, especially if they are already burning and they're managing cash? What should profitability mean to them?
Yeah, I think becoming capital efficient and reducing burn as quickly as possible is critical as we close out the year and prepare for 2021. We just don't know what's going to happen in the economic landscape. So you really want to reduce your burn as much as possible. If you've got unnecessary positions, or you're spending a lot of money in ads and it's not resulting in profitable revenue, cut it right away. Like when we saw the things that were going on in the economy, we had an emergency management meeting, and we created different strategies and processes in each division, in each department: sales, marketing, customer success, engineering, operations. We had to make critical business choices. Now, luckily, we didn't have to lay anyone off. Thank gosh for our execution. But the biggest thing that we had to do was we had to say, hey, let's cut any unnecessary travel, any necessary expenses, equipment, ads, you name it. Let's freeze that stuff. Let's focus on high impact, high revenue, high production type of talent and work. And then also we had an emergency company-wide meeting to say, look, if you're expected to do, let's just say it's 1 million, 10 million, 100 million this year, whatever activity and work that you're putting in to do the 100 million, it is now going to take us 300, 500, 1,000% more time, work, effort, capital, and failure than we expected. So if it would take us 100 calls, emails, social touches to acquire a customer, now it's going to take 1,000. And we had this massive emergency meeting with the team to say, to acquire new customers, to hit our KPIs, to hit our revenue, we have to go 3, 5, 10x bigger, harder, and in more production, just to produce the same results we produced in November, December, January, and February. And when you get everyone around the mindset and strategy to achieve our financial goals, here's now no one wants to have to put in 3 times the amount of work to produce the same results that they used to. But when you just eat that frog and you just come to the realization that, we call it embrace the suck, embrace the hard work that's ahead, then you get everyone rallied culturally around it and you attack it. The best way for everyone to survive and thrive and be ultra successful as we finish out the year and then go into 2021 is to look at your goals, revenue, your profit, your fundraising, and whatever activity it was, multiply it by 3, 5, 10x. And that way you will never underestimate the amount of work, time, capital, and effort it will take during this new economy that's been created with everything in the landscape.
Yeah. I also want to add too, I think at this point too, it's, for everybody, I think it's apparent that it isn't a V-shaped recovery. This is a sustained crisis that is with us in some form for the next year or two. So it is prudent to kind of take those steps to shore up the balance sheet in this next year or two, given that it's going to be an uncertain environment. As Daniel mentioned, if you get Paycheck Protection Program money and the sort of amazing programs, right, take advantage of those.
Pardon me. Okay, thanks everybody for the comments there. We have time for just a couple of questions, but before we do that, we'll be throwing up a survey to see how everyone enjoyed the session today. And then I really wanted to thank Brandon and Danielle for joining. It's been a real pleasure having both of you guys on here to answer questions and give us real life examples of what's going on in businesses today, especially SaaS companies. But yeah, if you guys want to leave a couple final comments about Seamless before we jump into a few questions here and wrap, that'd be excellent.
Yeah, no, I mean, we want to make this as valuable and interactive for the audience as possible. You guys can check us out, join Seamless for free. But I'd love to just fly down all of these questions while we're live with you and just give you our point of view from being in the trenches like you probably are.
Awesome. Thanks. I appreciate that, Brandon. If we can borrow a little bit of everybody's time as we approach the top of the hour. So maybe right off the bat, because this was asked a few times, Brandon, could you repeat some of the kind of SaaS KPI monitoring software items that you guys use or found valuable, like Baremetrics, et cetera? Some of the ones that you found value in?
So what's cool, if you go to baremetrics.com, this is an amazing platform that will literally give you all the business KPIs. We've got it tied to our Stripe data. You could tie it to any transaction software, but Baremetrics isn't the only one. You've also got a platform called Profitwell, a platform called Chart Mogul, First Officer, SaaS Optics, and MRR.io. And what these platforms do is they look at all of your conversion metrics, basically all your transactions, and then you'll be able to see what's my MRR calculated automatically, what's my ARR calculated automatically. MRR is monthly recurring revenue. Every month, how much money am I going to make from a customer? ARR is annual recurring revenue. How much money am I going to make annually from a customer? And then we'll give you average revenue per user. Like how much money am I making per customer? It will give you average run rate. It will give you MRR growth rate. How fast are we growing every single month, month over month? It gives you everything. So first thing I would have done if I could go back in time would be to get a payment gateway, attach it to one of these platforms, and it automates all of your reporting. So when I'm giving investor updates to people like John and Zach, I just log into Baremetrics and I take a screenshot and I send it to them. And then I provide like 3 bullet points, and now my monthly investor update is fully automated, good to go. So that's a great thing. And then use it every day. You got to look at it every day to make business decisions. Oh, hey, this news thing caused the oil and gas to go down. I see it's impacting our acquisition costs. Now it's costing us $1,000 versus $500 to acquire a customer. You got to use the data in real time that you're seeing in your business to then strategically make decisions in sales, marketing, customer success, and management.
That's awesome. Thanks, Brandon. And then this next one I know is John Prentice's favorite question ever. What's the difference between recurring and reoccurring revenue?
Oh, that's a hard one. Well, it's a debate too among our team. I mean, so recurring, I would say, is generally your more SaaS subscription model, right? Like what Seamless has, right? Whether it's monthly, kind of annual contracts. Kind of reoccurring would be more kind of repeat usage. So could even be like a B2C company that has like repeat customer sort of thing, or maybe you're a services company and every year your same customer comes back and renews that contract. Generally, it's how we delineate. So I always like to think in terms of true kind of SaaS subscription versus kind of non-true SaaS subscription.
Thanks. Now here's another question. Does ARR typically include upfront fees like that implementation or other kind of upfront fees?
They will have a tab titled like other revenue, and then also it will be included in net revenue. So you've got other revenue, you've got net revenue. It is other fees are typically not associated in ARR. ARR is just what is the annual recurring revenue that I know I'm going to get every year and every month.
Yep.
And per John's response, implementation could be reoccurring if you're constantly bringing in new customers, but it's not truly recurring revenue per se. That's required to be paid by the same customer over and over and over again. So I guess this question would be more to John in terms of what Lighter Capital looks for. Someone's looking at launching a pre-revenue company here this year. When does it make sense for them to start talking to Lighter?
Yeah. So on our end, we don't work with pre-revenue companies. So we need to see a company that's been around for at least a year, that's 6 months of revenue history. And then we like to see at least kind of 15, 20,000 a month in monthly revenue. So call it kind of close to 200,000 annualized revenue. That's when we start working with the company and evaluating options.
And then back to Brandon or Danielle, another question about Barometrics. Do you guys know offhand if obviously it integrates with your payment systems, but does it integrate with CRM like Salesforce, HubSpot, or Google Ads, other things like that?
Great question. I wish it did. It's mainly just a data visualization platform for the business metrics that connects with payment gateways. So unfortunately, the quick answer is no, it doesn't.
Awesome. And then, yeah, it looks like we're through a lot of the questions. If anyone has any final ones, go ahead and pop them into the Q&A right now. We'll give them just a second. And then while we're doing that,
Yeah, it looks like someone asked about, what do investors look for? Is it profitability or is it like ARR growth rate? I think it depends on the stage, right? If you're in a startup or a growth phase, investors are really going to be looking at the growth rate, the MRR, the ARR, and the growth rate. If you're looking at a big round of funding, maybe it's a private equity deal, they're going to be looking at EBITDA, and then they'll value the business based off of EBITDA. If you're under 20 million, 15 million, 10 million in revenue, just worry about getting the MRR and ARR as high as possible while effectively managing your burn and trying to achieve profitability, because all the investors, sub 20, all they care about is growth. Post 20, if you're working with PE or acquirers, they may be valuing you on EBITDA.
Yeah, no, that's totally spot on. I mean, it's a different kind of profile investors once you get to that 15, 20 million a year in revenue. So on the earlier stage side, right, your typical kind of Series A investor, VC, they're going to be more concerned about growth. They actually want to see that a company is burning and investing in sales and marketing to keep that growth. But as you get to that later stage, definitely kind of flips a little bit. Have a growth equity, private equity.
And looks like we have a question for like an early seed stage company. As they're thinking about customer engagement and time on product or user retention, are there any kind of key things they should be looking for? I guess it probably varies depending on the type of offering that they provide, or any comments around that, Danielle or Brandon?
Yeah, we're trying to really analyze, and this is, again, it depends on the stage of the company. It's hard to do at the beginning, and it gets easier over time. And hopefully over time, you start to master it, where we watch every behavior that a user does. We've got analytics platforms like Mixpanel, like Churn Zero. Churn Zero is a customer, and we're a customer of theirs, where it will give us a health score of every single one of our nearly 10,000 customers. And then we know, are they in the green? Are they in the yellow? Are they in the red? Which means they're not using the product as much. And then we try to figure out what can we do to get them to use the product if they're not using it a lot. What can we do to get them to use different features that are critical to onboarding and setup? So you really want to track, you want to track all the data. Hopefully when you walk out of this meeting, you've got an idea of what is all the data I'm not tracking, and then start exploring how you could track it. Because the more I know we started tracking all of the data, our success just constantly increased because we were able to make the right strategic executional decisions to increase profitability, to increase our customer acquisition results, and to increase our market share and value that we deliver to our users. So try to track every single interaction that a user makes, and then architect a product-led growth strategy. You know, what are the emails I'm going to send, the in-app messages, the notifications, the text messages? What are my CS people going to do? With all this data, you could do a very aggressive product-led growth strategy that gets them to love and use your product every single day. And that's where, you know, that's the holy grail of SaaS. Daily active users, they call it.
Constant engagement. And another question that just came in, maybe relative back to Danielle and Brandon, how do you even come up with a pricing model? You know, do you charge $1? Do you charge $1 million? Like, how do you even hone in on what you should charge your users, you know, to use your offering?
Yeah, a lot of it was guessing at first, right? I mean, you look at the market like, okay, what are similar products being priced as? But then you've got companies like Tesla and Apple, where a phone may cost $100 and then come out with $1,000 phone, and you're just like, wow. So, you know, you could look at other players in the space and figure out, okay, I'm going to price similar to them. You could do the exact opposite. Whatever these people price it, I'm going to 5 to 10x it, and the perceived value of my product will be worth it. And then you just have to sell it and hopefully hit it. For us, we did a mix of looking at competitors in the space and then also just testing. Like, the best reality is testing every single thing with a customer or a user or a prospect, and then seeing would they buy it or use it or perceive value from it at that price point. Like, if you're going to try to sell an Apple iPhone for $100,000, you know, there's probably a few people that feel that the value is there for $100,000, but maybe at $10,000, you know, maybe at $5,000, maybe Apple's underpricing their iPhones, right? So, you know, you just got to do the market research and then test with consumers or your customers to see what's the ideal state. And you'll be able to get the data to figure out what's the perfect. It takes a while. That's hard to nail.
A lot of A/B testing, I'd imagine.
Yeah, tons of A/B testing.
All right, I think we're through the predominance of the questions here. So happy to continue to answer some over email if anybody has any questions there. And if you do, I'm bringing this back up, you can shoot them to lcwebinars@lightercapital.com. We'll try to get to as many as we can that come in through email as a follow-up. And as a reminder, this will be recorded. It's been recorded, so we'll send a copy of the recording and a follow-up email to everybody so they can go back and rewatch. But again, I just really want to thank Brandon and Danielle. This has been wonderful. You guys have provided a lot of insight. I think it was really helpful for the audience today, and we just really appreciate you guys from Seamless joining.
Yeah, thank you everyone so much for tuning in. We hope it was valuable, and feel free to connect with us on LinkedIn. We share daily strategies, secrets, tips of entrepreneurship in the trenches. You know, it's a hard fight to go from 0 to 1 or 1 to 100 or 100 to 1 billion, and we're all in this together. So we look forward to connecting with you, and hopefully you've taken away something of value to make your business better.
Awesome. Thanks, everybody. Okay, bye-bye now.
Thanks, guys.